If you've ever watched price explode hundreds of pips without giving you an entry, or wondered why some breakouts never retrace while others fail instantly, what you're experiencing is price transitioning from balance to imbalance. Because every move in the financial markets begins with one thing: an imbalance in the auction. If you don't understand that, you'll forever chase candles instead of understanding why they formed. Today, I'm going to show you how auction market theory explains the formation of imbalance, why it happens, how to recognize it before everyone else, and why professional traders pay close attention whenever an auction loses balance. So let's get started. Imagine you're standing at an auction for a rare luxury car. The auctioneer begins. $20,000. Several people raise their hands. $21,000. More bids. $22,000. Still plenty of interest. At this point, the auction is healthy. Both buyers and sellers agree that the current price is fair. Transactions happen smoothly. No one is in a hurry. No one is desperate. This is called balance. Now imagine something changes. Perhaps someone discovers that this car once belonged to a famous celebrity. Instantly, everyone wants it. One bidder shouts, $30,000. Another immediately says, $35,000. Then someone else offers $40,000. Notice what happened. The auction skipped many prices. Nobody wanted to sell at $23,000 or $24,000. Demand became so aggressive that the auction raced upward, searching for the next price where sellers were finally willing to participate. That rapid movement, that lack of trading, that urgency is exactly what financial traders call an imbalance. The market simply moved too quickly because one side became overwhelmingly aggressive. Exactly the same thing happens every day in Forex, gold, stocks, indices, and cryptocurrency. Auction market theory says that markets have only one objective: to discover fair value. When buyers and sellers agree on price, the market rotates. Price moves back and forth. Volume builds, time is spent. This is called price acceptance. But markets never stay balanced forever. Eventually, fresh information enters the market. Large institutions decide to accumulate or distribute. Aggressive orders overwhelm passive orders. The market can no longer facilitate trade efficiently, so price must leave that area. It searches for another location where buyers and sellers will once again agree. That journey from one accepted value area to another creates imbalance. This is why trends begin, not because price is random, but because the auction has temporarily lost balance. Here is where it gets interesting. Imbalance is where the money is made. It is where you can catch a good trade with an excellent risk-to-reward ratio. But there is a problem. Some imbalances are false. They are only meant for liquidity grabs. Others are valid and later develop into a trend. So how do you identify the valid imbalance that will later form a trend? Do well to subscribe to my TikTok page and follow closely so you don't miss what comes next.